The Rebel Capitalist Show.
What would you do right now if you're still managing money, looking at what's happening in China with the experience that you had 12 years ago?
I'd be short the currency.
Okay.
I'd be short the currency. I would be long. I would have. I would try and get a lot of leverage from Eurodollar options. So I think you will see. So here's a bold claim. Here's a bold and foolish claim. I think there's a tradable probability that you could see negative money market rates in the US play out over the next 2 years. In this year of plenty, and this year of, they call it boom, catch up, right, which doesn't take us back to trend.
Right.
The biggest task for the Federal Reserve this year has been preventing money market rates going negative, owing to the demand for safe treasury bill collateral. They're like, I'll lose a bit of money. I'll go negative. And the Fed's like, no. Okay.
Yeah.
So if
just to be clear, guys, Hugh's referring to what they've done with interest on excess reserves or interest on reserves, IOR, and they took it from 0 up to 5 basis points, which is still within their range. They're not technically raising interest rates, but they're raising it to 5 basis points to prevent those T-bills going negative.
So they're offering a competing bid to the market. They're saying, keep your money in safe custody with us. We'll pay you more than market because we have an agenda. We do not want to legitimize negative rates on our watch, on our brief.
Yep.
And so the Eurodollar curve is expecting over the next 2 years about rates going up to like 1.5.
Yeah. 2023 is about 1.6, something like that. And then from 23, then it starts going down.
So imagine there's zero in 2 years. China, if anything we've talked about with regard to China, began to be assimilated via risk markets. They're going to be zero, and they may even go negative. So the convexity, the return from the most unexpected set of outcomes, obviously would be very high. And then finally, I have a watching brief, nothing much yet, but so when I talked about my blow-up fund, remember back 12 years ago, I was long Australian Treasury bond yields at 6%. But I was also buying credit default swap spreads, right, on Japanese companies which were heavily influenced, whose profits were heavily influenced by economic growth out of mainland China. And essentially, I could buy $1 million worth of protection of default for like, was it $25,000 or 2.5, like for nothing, right? They're still priced that way. And so if any of this comes true, George, it will be similar to the devaluation in Thailand. And I know this because of Jeff Snyder. The first indication was Bank of Tokyo Mitsubishi, the biggest bank, the safest, biggest bank in Japan, and by definition, one of the biggest, safest banks globally. Their CDS spread and their interbank market, like the cost that they had to pay to borrow money from their peers from other international banks, boom, blew out. And it was because they were beginning to pick up, they had such an exposure to the Thai economy. It always reveals itself. It'll reveal itself in some of these more arcane, specialist markets. But those things are priced just now at like 40 basis points, and they could trade 1,000, 1,500. That's the kind of convexity.
So that's what would be on your watch list, so to speak, right now, if you were managing money.
And then I would have a modest short position in the renminbi. Modest because it is trending against me. And so I always need the legitimacy of trend. So despite all of this, the Chinese currency is strengthening versus the US dollar. The US dollar is appreciating against all currencies in the world, bar the Chinese. The Chinese, like you noted, 27% of their economic growth is contributed from property construction.
Right.
They have 95 million units to complete, which is insane. So that's slowing down. Their other economic engine is exports, and their currency is getting stronger and stronger. Is it a ticking bomb? I don't know. Is it a volatility machine? So at some point, things are going to reprice. I don't know when.
Yeah, right.
But I wouldn't have a big position because I like to see change. Like I said to you, if you believe in inflation, if you want to short treasuries, seek the legitimacy of price and wait until 2% for treasury yields. And for me, this has been a great, fun Friday night conversation. It's still in the realms of fantasy,
right?
But if the Chinese renminbi were to kind of weaken from 633 to like 653, which is in the scheme of things nothing, be like, ooh, that's interesting.
Yeah. Right.
The only thing where I have legitimacy to take a position today, George, would be something in the US money markets, the US treasuries. There you've got legitimacy. Everyone's kind of going, this is weird. And actually, through this lens, it's not weird. It's like, this is why. So I'd start there, and then I would wait for corroboration in market prices elsewhere.
Got it.